Greetings, everyone. It is Employment Friday. Once again, happens once a month. So glad to be back. And today we're going to do pretty much the usual with a special treat up front. So first, we're going to talk about Bitcoin. A lot has happened in the last few weeks. And so Yassine Elmandjra, Director of Digital Assets at ARK Invest, will be sharing some thoughts about the halving in particular. Then we'll continue on with more monetary policy, fiscal policy, economic indicators, market indicators. And then at the very end, we will discuss the serious concentration that is taking place in the broad-based benchmarks towards a few names, and just put that in the context of history. So pretty interesting charts. With that, let's bring on Yassine Elmandjra. Hi, Yassine.
Hello, Cathie. Thank you for having me. Very exciting times for Bitcoin. As we know, Bitcoin just underwent its fourth monetary policy halving, and ARK has been a part of three of those halvings. Crazy to think about. Yeah. Dropping from 1.8% issuance rate to a now 0.9% issuance rate, which for the first time in Bitcoin's history is now below gold's issuance rate. So just to level set on what the Bitcoin halving is, it occurs roughly every 4 years, and it really is an elegant reminder of Bitcoin's predictable monetary policy and its role as a scarce asset. So Bitcoin has a coded, mathematically metered supply that's baked into the software's rules, where the reward for mining a block effectively gets cut in half every 210,000 blocks, or roughly every 4 years. The first halving occurred in November of 2012, where the block reward was reduced from 50 Bitcoin to 25 Bitcoin. And this most recent halving has reduced the block reward from 6.25 Bitcoin to 3.125 Bitcoin per block. So as you can see in the chart, that issuance rate has gotten cut to below 1%. And the green line is Bitcoin's circulating supply, which is roughly 19.5 million of the total 21 million. So over 90% of Bitcoin supply has already been issued. From a price action standpoint, the Bitcoin halving tends to coincide with bull markets. So Bitcoin's now trading at roughly $60,000, and it's gone through a pretty nice reset after making all-time highs in March. And so we like to look at just healthy resets, healthy liquidations on the longs, especially during a bull market. And we've seen a 22% drawdown from the all-time highs, which tends to coincide with what we've seen in previous bull markets as kind of local corrections. Regarding Bitcoin's predictable monetary policy, it really is one of the primary reasons why we have such high conviction in Bitcoin and why we have had it over the years. And we've really taken a monetary lens on assessing the potential for Bitcoin versus that software technological lens. And that really comes down to Bitcoin's monetary policy. So Cathie, I've learned a lot from you just on monetary history, monetary economics. Maybe you can sort of put that monetary hat on and really highlight the sharp contrast with Bitcoin's policy versus, central bank policymakers that, can adjust the supply growth idiosyncratically at will.
Absolutely. Well, this halving chart is, you can see the discipline here as Yassine said. It's been mathematically metered, and actually, we did a Bitcoin brainstorm with miners, and I think Yassine's going to tee that up in a minute. But this monetary policy basically was written in 5 lines of code. I did not know that until we did that Bitcoin brainstorm. It is so elegant, so simple, so straightforward. So in contrast, take a look at this. All right, this is M2's M2 growth, and it's a 4-year annualized percent change. So from March this month to March, or this past March to March 4 years ago, what is the monetary growth rate at an annual rate? That would be the last data point here, which is, you can see the black dash line. So that rate is about 8%. And actually, probably it's closer to 6%. There's a lot of data on this chart. But take a look at the 4-year growth rate of M2, and you can see it's all over the place. You can see in the 60s and 70s, it moved toward double digits, and we ended up with double-digit inflation in the late 70s, early 80s. It took a while to get there, and it seemed to be very sticky. And then after Chairman Volcker came onto the scene, I think that was 1979, he said, we have to get this thing under control. And he started choking money supply. And that momentum actually continued into the mid-90s. And then in the mid-90s, it was very interesting because it's somewhat similar to today. In the mid-90s, there was a domino effect of currency devaluations around the world. Our monetary policy was propagating throughout the world because it is the world's reserve asset. And the first devaluation actually was Mexico. And it was a big one. I remember it very clearly because we were involved with Mexican stocks. And then a few years later, we had the Asian domino effect. I think the Thai baht devalued in 1997. And then the rest of Asia's currencies devalued. We had the Russian default in 1998, and then we had long-term capital falling apart. Monetary policy propagates through the system, and when it's so unpredictable, it leads to all kinds of excesses. And so what do we have now, where we see what happened because of COVID? That drove the 4-year annualized growth in M2 up to 12%. And then now we've had a very sharp deceleration, unlike the 70s, 60s and 70s, where there was sort of an acceleration, at least in the sense of a trend, and a stabilization near double digits. Here we had money thrown at the system to prevent an outright depression. And if by the end of the year we stabilize around 0% year-over-year growth, that's year-over-year, this line will drop toward 2 to 3%, which, as you can see, we've only seen once. It was in the 90s. And, after that, all hell broke loose around the world. It is interesting to note that the devaluations, there are many devaluations taking place in the rest of the world today. I've mentioned in the past Egypt, I think, devalued by 40% in February or March. The Nigerian naira is down 50 to 60% in the last 9 months. We're seeing the Indonesian rupiah devaluing at an accelerated rate. And in Latin America, of course, Argentina basically recognized that the black market had it right, that its currency, at least publicly stated, was about 50% of that rate in the black market, and that was correct. So we're in a very interesting environment, and it's caused by monetary instability around the world. And so I often talk to Yassine about these devaluations, and of course, in emerging markets, anyone with a connection to the internet now pretty much can establish or buy an insurance policy in the form of Bitcoin, which, just flipping back to the halving in this purple line, doesn't look anything like the volatility you see in monetary policy here in the United States and around the world. And of course, it's controlled by human beings. When we went off the gold exchange standard and closed the gold window in the United States in 1971, monetary policy just became unhinged, and it has been unhinged ever since, although human beings have tried to contain the inflationary ramifications, and they take it too far both ways. And right now, we think they're taking it too far on the downside. And I'll get into that as we go through some of the rest of the monetary indicators and the economic and market indicators. But Yassine, before I do that, maybe you'd like to add a few more.
Yeah, Cathie. I mean, what you're saying is really just a byproduct of having an opaque and unpredictable mechanism to enforce rules, right? The unpredictability of a lot of the monetary policies that we see, in emerging markets and even in the U.S. is a function of just the lack of transparency in being able to make those decisions. So Bitcoin doesn't have a central bank board of governors. It has code that reinforces its very predictable monetary policy, and that's really a testament to the robust system of checks and balances that Bitcoin has. Cathie, you mentioned the Bitcoin brainstorm. We had that recording last week where we really go deep into these systems of checks and balances across all stakeholders, miners, entrepreneurs, investors. We also recently published a piece highlighting Bitcoin as a unique risk-off asset, and part of the value proposition of Bitcoin in being a decentralized open source software is beyond just its monetary policy, its openness, its transparency, and its auditability. And in a time of opaqueness and instability and unpredictability, Bitcoin positions itself very uniquely as a risk-off asset, while traditionally it's been labeled as exclusively a risk-on asset. And then we also have the Bitcoin Monthly that we publish on a monthly basis. We're Friday the 3rd of May, and you should expect to receive our most recent edition of the Bitcoin Monthly early next week. So stay tuned for that.
Yeah, and I think Bitcoin Monthly helps me understand the health of the system. I mean, the transparency of the network has given us a great opportunity to understand what's going on out there, and Yassine and his team are able to gauge where we are in the bull market based on some of the indicators and how they've behaved in the past. And before handing it back to you again, Yassine, I wanted to highlight one point. It is amazing to me that Chairman Powell and the Fed governors, as you mentioned, there are no Fed governors here in the Bitcoin ecosystem, but there are in the United States. And every time one of them speaks, markets move. And you know what? As I said, they overdo it one way, then they overdo it the other way. And it's just contributing to a lot of instability, not only in the markets, but also in the economy, I would submit. So back to you, Yassine, for last words on this section.
Yeah, we're keeping a very close eye, as Cathie mentioned. The Bitcoin Monthly is a great sort of pulse check on where we think we are in the markets. You can obviously visit that see that at ark-invest.com. We have a dedicated Bitcoin section. So Cathie, really enjoyed this conversation, and I'll be just tuning in from the background on the rest of the conversation.
Yeah, just before
definitely.
Just before you go, Yassine, I think it's been helpful for me as I'm looking at Bitcoin Monthly and talking through this with the team, that we can see that, and we believe that the bull market in Bitcoin is not over. So I would encourage everyone to take a look at that piece when it comes out, and get kind of hooked on it, because it's very helpful.
Yeah, absolutely. I think one of the things that we take a look at is how to assess Bitcoin's fundamentals, and we use on-chain data, which is derived from the Bitcoin's public blockchain, that allows us to assess buyer and seller behavior, cost bases, transaction volumes, active addresses, and we monitor that on a weekly basis. And based on the numbers that we're seeing, and you can see that in the Bitcoin monthly as well, we believe that we still are in a bull market, very likely the second half. And historically, that has coincided with the Bitcoin halving. So we like this really healthy reset. The healthy reset has reinforced a lot of the longer term holding behavior, which we'd like to see. And all of that can be dissected and ultimately synthesized using on-chain data. So definitely take a deeper look at the Bitcoin monthly for more insight on that.
Yeah, and I guess there was a lot of anticipatory behavior, because many people have learned about the halvings and what has happened historically after halvings, and I think they got a little impatient after the Bitcoin price did not rocket after the halving. So the reset, I think, is very healthy, and it was very interesting to watch it in the on-chain indicators. So, okay, Yassine, thanks so much.
Thanks,
All
Cathie.
right, okay. And now what I'd like to do is finish on monetary policy, and go through the drill. We've been through this month to month for a while now. And here you see M2 money supply growth versus CPI. You see money supply, the purple line there, is still negative, but not as negative as it was. That's interesting. You can also see that the CPI is kind of stuck in the 3 to 3.5% rate right now, or at a 3 to 3.5% rate. And what we think is going on right now is that companies are seeing their unit volume growth disappointing. And so they're trying to make it up with pricing. And in doing so, they're actually turning the consumer off more. It's not working. And I'll show you some indicators a little later on to that effect. So we think that they will be forced to take their inflation rates down if they want to invite the consumer back into buying products and services. So we think that this will resolve to the downside. It's been in a range now for, it looks like nearly a year, in this 3 to 3.5% range. And if you look at the underlying economy, we're seeing the consumer starting to give way. We've seen it in different ways, housing related, auto related, but now we're talking about restaurants, which certainly have had a strong period as fiscal stimulus was burgeoning, but that's over now. And we do think that the inflation rate is going to look a little bit like the money growth rate. We've been saying that we think it will turn negative at some point, and we still do. The biggest lagging indicator in the CPI is rent, and we're seeing signs of rental prices coming down. Actually negative in many parts of the United States. And so that alone will start pulling this down. We're seeing auto prices coming down as well as dealers try and move those units. Tesla's well advertised price cuts, maybe leading the charge, so to speak there. So we think that we do not think inflation is going to stay at this level, we think it is going to resolve to the downside in the next few months. And then here is the yield curve. We focus on this because it typically, when it's below zero, this line, it means that 10-year Treasury yields are below 2-year Treasury yields. And that is still the case. It's usually a harbinger of recession or much lower than expected prices. And I've focused us on this yield curve. If you look at 0809, where it peaked, it looks like it's been on a constant downtrend from a trend point of view in hindsight. And I do think that is saying something about the deflationary undercurrents in the global economy, and that they will continue to build. I know that everyone's focused on inflation, but we're going to show you some charts that would suggest that that is not the risk. So this has not changed. And the idea that we're going to have a soft landing, which is the consensus view right now, this chart would argue against it. In fact, you can see, except for the 80s, every time it has been at this level, we have ended up in a recession, which you can see by the shaded lines. It took more of an inverted yield curve to get a recession going in the 80s, but every time since, we've pretty much had a recession every time the yield curve has been around this level. And we've been talking about a rolling recession, housing, autos. We'll get into that more. Now we're seeing more capitulation more broadly from consumers. Here's the real Fed funds rate. So the Fed funds rate is roughly 5.5%, and 5 to 5.5%. And you can see the minus 3% gets us to 2.5% there. If inflation does come down the way we expect, and the Fed does not cut rates, which the markets now don't expect one until November, if they don't cut as inflation's coming down, then this line is going to go out closer to 5%. Again, we haven't seen that really since the 80s, when inflation was still considered embedded or at risk of going back to double digits. We're nothing like that today. On the next page, this slide is how long the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 0809 global financial crisis. So that was 0607. It was a harbinger of the tech and telecom bust in 97, 98. And in 1969-70, it was the harbinger of a recession, and the closing of the gold window as well. So they haven't been great periods, or at least harbingers of great periods. So we are taking due note. So just a quick note on fiscal policy. You can see the deficit. We present this each time, and just want to reinforce that the antidote to this deficit, which in a so-called expansion is at 6.5%, that really has not happened except in the aftermath of the 0809 meltdown, while stimulus was still flowing freely in response to it. But we're not in such a meltdown now, and we do believe growth is going to be the solution, as it was in the 90s. You can see the 90s in the Clinton administration, for the most part, we ended up back in a surplus, which was a function of the very good growth. And I'll mention that the internet really started to take off in the early 90s, and that was a big part of that decade of growth. And we think the ChatGPT moment is very similar to what happened in 1993, which was the first time that email was connected to the internet. It was a big aha moment, just like ChatGPT was for artificial intelligence. And we think AI is going to be a huge catalyst and is going to stimulate and accelerate the growth in our other innovation platforms, which are robotics, energy storage, blockchain technology, and multi-omic sequencing in the life science space. All of those are getting ready to deliver massive growth rates that will really move the needle in terms of GDP. Unlike the aftermath of the tech and telecom bubble, the technologies, the internet was going and the growth was very good, but some of the expectations, like personalized medicine, we were not near that at all. We are now. And so we think that this federal deficit, if there's any discipline whatsoever in terms of spending, that it could move into surplus territory, which is something that the market does not expect. Listen very carefully to the candidates, all three of them, as they put forth their economic plans, and we'll be talking a lot of about those in the future. But tax rate increases, especially capital gains tax rate increases, would undermine the scenario I just presented. So we definitely don't want those. All right, on to economic indicators. Here's sentiment, consumer sentiment, and it does seem to have bounced on University of Michigan sentiment basis. But you can see, if you look at where the economy has been in past cycles, when it's been around these levels, we've been pretty much either we've been in many cases moving towards a recession, and you can also say we were moving towards a soft landing. So it's kind of in never land right now. The last tick was down. It was a small tick down, but pay close attention to this. We think there will be more ticks down, because we do think that today's unemployment rate was a harbinger of more soft employment numbers to come. And before I get into employment, I do want to reinforce what I'm saying about that sentiment indicator. It's probably on its way back down. This is a good indicator. Here we've got 4 really fast casual or fast food restaurants: Yum, Starbucks, Chipotle, and McDonald's. And you can see they are resolving to the downside. There's no pickup here. And we'll get into why in a few moments. But I know that to see Starbucks sales, these are same store sales, but total revenue at Starbucks was negative. And that we did see negative in COVID, of course. But for Starbucks, that's been highly unusual. And it's basically saying, Starbucks is discretionary. I mean, you don't have to go out and buy that cup of coffee. You can make it at home. And I do think that trading down is happening. So negative numbers, highly unusual there. And they're all soft. Chipotle's held up the best, I think. And I think they're being sensitive in terms of pricing. I think they've taken they're limiting the chicken dishes because that's still high priced. And so I think they're being more sensitive from a pricing point of view. On the next page, this is the employment Friday. So we got a soft employment report. Non-farm payroll was 175,000. Expectation was up 240,000. So a big miss there. And if you look at the revisions, I think the downward revisions were 22,000. And we've had consistent downward revisions, which is consistent with, I would say, not a soft landing, a harder than expected landing. Another thing that goes into these statistics, and I haven't really talked about it before, it's pretty consistent though, is something called the birth-death ratio. And this has to do with new business formations and bankruptcies. When we're going into a recession, that number tends to be revised down. Normally, the net number is a positive. And this last month, it was 110,000 jobs net from this net new business formation. Well, if that's wrong, and as we enter into recessions or harder landings, banks refuse to lend money, and they are refusing to lend money to small businesses, and small businesses are not happy about this. Probably means that 110,000 increase in employment because of net new business formation is an overestimate. So the employment numbers are probably weaker than what we're seeing now. And that's corroborated by the household employment measure, which was up only 25,000 last month. We saw average hourly earnings up 0.2%. 0.2% was less than the 0.3%. It's down to, on a year-over-year basis, average hourly earnings growth is down to 3.9%. We got a productivity measure this past week, which on a year-over-year basis, non-farm productivity was up 2.9%. If you subtract that from the 3.9% in terms of average hourly earnings, or even the 4.8 in the employment cost index, we're below 2% inflation. And so on this metric, which is the real way you should be looking at, certainly wage inflation, we're below 2%. And, I think that that is going to continue to drop if we're right and the unemployment rate goes up. There was one other thing to note, and that was the unemployment rate itself went up to 3.9. We think in the next year it could go up to 5%. And these moves tend to happen rapidly. Here you can see non-farm payroll employment on a year-over-year basis is pretty much flat. I think it's 0.3%. That's with today's number. And you can see non-farm payroll has dropped below that 2% to 1.8%. And we think the deceleration will continue. If we go to the next chart, temporary help was down another 16,000. And you can see, except for the COVID shock, you have to go back to, I think it's 2014 to see temporary help employment this low. So businesses tend to not hire on a temporary help. If times are getting tougher, they'd prefer to cut back there than cut back on their full-time employment. On the next page, quits rate. The quits rate, it continues to fall. People quit jobs, and you saw this in the aftermath of COVID, if they think they can jump to another job and get a higher wage rate. You can see that's been coming down. We're now where we were before COVID. Actually, you have to go back to 2017-18 to see a lower number here. And you can see that the employment cost index is coming down on a year-over-year basis alongside this quit rate. Here is another reason the restaurant sales are starting to capitulate. The personal savings rate is at a very low level. You can see before the 08-09 crisis, the saving rate was similarly low. What was happening back then was home prices were spiraling to the upside, and consumers were tapping into home equity to supplement their consumption. Consumers are not doing that now. The interest rates are too high, so they're not taking home equity loans like they were back then. So saving rates very low. If the unemployment rate now goes up, the tendency for this number, and you can see this, what happens before the shaded lines on each chart here, if the consumer feels, or consumers feel they're going to lose their jobs, they actually try and bolster their saving rate, which really hurts consumption. So maybe one reason those restaurant sales are starting to come down now. Here, just a reminder that we've been in a rolling recession. To see existing home sales drop from nearly 6.5 million units to we're now in the 4 to 4.5 range. That's been a huge hit. Of course, interest rates directly implicated there. On the new home sales, you can see after rising from 2010 to 2020, they also have been in somewhat of a recession territory. You know, there is a housing shortage out there, and yet interest rates have destroyed affordability, and so even here we're continuing to see weakness. Auto sales, we got another number. It was in the high 15 million units at an annualized rate, so it's kind of stuck, 15 to 16 million. We think this will resolve to the downside as well, unless, and Tesla certainly is doing this, unless auto companies cut prices significantly. Now, with Uber and Lyft these days, you know, the imperative to have a car just is not as much as it was before in the early 2000s. So maybe we will not go back to the 17.5, 18 million units which was steady state at some point. Maybe the new steady state is 15 to 16 million, and will go down from there in weak periods of activity. Here, I mentioned earlier, small businesses are not happy. If you look at the NFIB, National Federation of Independent Optimism Index, it has dropped. It's breaking down again after stabilizing for about a year or so. But I think this is in response to an inability to get credit. Liquidity is drying up, and you can see we're in 08-09 territory. We're down below COVID territory. So this is quite serious. And, you know, small businesses tend to be the biggest job generators. And so this is not a good sign for employment going forward. Here, this is just one of the first April numbers that comes out, and you can see there was a capitulation here in the Chicago Business Barometer. So we're back in recession territory. If you look at the times in the past it's been here, every time we have been in a recession. So again, this soft landing and you know, the lagging indicators out there that the Fed is using are not capturing this sensitive data. Okay, now on to market indicators. I'll start with the dollar as we always do. And I think it's because, just to mention or repeat something that Yassine and I mentioned around the Bitcoin discussion, there are devaluations taking place around the world, and that's inflicting a lot of pain on those populations. US, the dollar's been pretty strong actually since 08, 09, defying expectations of those who are saying that our twin deficits, the budget deficit and the trade deficit, would drive the dollar down. The dollar is the world's reserve currency. And so in a bit of a flight to safety, the dollar is still getting a bid, and even against the yen. So this is the yen, and if the line is going up, then the yen is devaluing. The dollar is going up, the yen is depreciating. You can see how long a period the yen did appreciate. It was really in a trend sense through 2013. And since then, it has been depreciating. That's a huge depreciation from, roughly 75 to 150. That's, it's lost half its value since then, which relative to other currencies. And you can see very recently, it broke down again. It went to 160. And the Japanese monetary authorities intervened. What does that mean? They bought yen, which is tightening their liquidity, pulling yen out of the system, and they sold dollars. And that adds to dollar liquidity at the expense of the Japanese economy. So that's interesting. Even Japan is suffering from the devaluation that I think our monetary policy has been a part of making happen. Here's the Bloomberg Commodity Index. And we have to answer to the fact that the gold price has broken out of it had been in a range. It had based for quite a time. That the top had been 2100, and it popped above that. It has popped above that in recent weeks. But look at what the overall Bloomberg Commodity Price Index has done. It has done nothing. It's been going down for the last few years. And I think that's partly a reflection of what's going on with the dollar. The dollar is up. Most commodities are priced in dollars, so the commodity prices are down. So that's definitely one reason. But there is a lot of softness around the world, including the U.S. industrial sector, which still seems to be in recession. A lot of those companies in earnings season are reporting negative year-over-year numbers, so revenues falling. And I think this chart highlights something that I've been saying for some time. Commodity prices today are where they were in the early 80s. And here we have this, the narrative out there saying, we have an inflation problem. Look at what's happened to this. You've seen since 2008 a downtrend. Sure, you've seen movements, fluctuations within a downtrend, but there's a downtrend nonetheless. And I often mention Kondratiev here, where it's when policymakers have not categorized the backdrop correctly, and in this case, characterizing it as inflationary. And here's an indicator that's saying, heck no, it's not inflationary. The risk, therefore, is deflation. And we really do believe that is the case. Here's another way of talking about what's happened to gold. So the purple line here is the ratio of metals prices to gold prices. Now, I just told you that gold has moved up out of a trading range. Many people would say that's a harbinger of inflation. This chart would say absolutely not. This chart, this metals to gold ratio, is basically saying that the purchasing power of gold has gone up, and that the reason it probably has gone up is it's a flight to safety as these devaluations are taking place around the world. We're even seeing central banks increasing their gold positions, and especially in China. China has taken its dollar reserves down. We don't know if that's they're making that an explicit move, and buying gold instead, or if it's a function of a deterioration in trade. But nonetheless, the Chinese dollar reserves are down from $1.2 trillion to, I think, $750 billion over the last few years. And China has been buying gold, as have many other central banks. And one of the reasons China and maybe Russia as well have been doing so is they don't like it that the dollar is the world's reserve currency. So think about it. The dollar is going up despite that kind of activity. And here, the purchasing power of gold is going up. And you can see that this line is basically where it was during the thick of the crisis in 08, 09. That was surely a flight to safety moment. What is not the same is the green line. The green line is the 10-year Treasury yield. And you can see how tightly correlated these two indicators were in the post-08, 09 environment. And even before, they were pretty tightly correlated. As you can see, they've broken apart. They started breaking apart when the Fed started tightening. And so we think long rates have gone up mostly because the Fed has tightened, and the yield curve can only go so negative. This, we also believe that this is going to close. How is it going to close? Well, our bet is that the long Treasury bond yield will come down. If we're right that the U.S. is going into a harder landing than most anticipate. The metals to gold price could go up, but that would mean a burst in the metals prices relative to gold, and that is not happening. Copper has come up, but other metal prices have come down. And so that would be our bet. Of course, they could meet in the middle, both metals going up relative to the gold price and the Treasury yield coming down. But we think the most likely, given what we expect for the economy, is that the Treasury yield comes down. And then this chart is still the conundrum out there. These are credit default swaps, so the price of credit default swaps. And normally when they're going up, we're in a risk-off situation. And you saw that happening certainly as the Fed started tightening and continued tightening. It stopped tightening, and we got the idea that it would. And the credit default swaps, which are really insurance policies against bankruptcy, they have settled down. But if we're right on what's going on in the rest of the world and in the U.S. and what is likely to happen, the credit default swap should have stayed more elevated. What we think is going on is a lot of private equity money is sloshing around in the system. And they're buying up companies that we think, or supporting companies that we think would be in trouble otherwise. We shall see, but you can see recently they've both ticked up, and stay tuned. So now on to the last segment here, just quickly to highlight something you may hear about in the news, but has reached quite extreme levels. Here you can see the common holdings. In green, it's the common number of holdings between the S&P 500 and the NASDAQ 100. So the NASDAQ only has 100 in it. And 84 names are commonly held. And the overlap is 45% in terms of weight. That compares to where we started in 02, and that was in the 12.5% range. The market's become very concentrated. Another way of saying this is the active share of the NASDAQ 100 has gone down from 87% to 55%. And we've always said that our strategies are starting to fill the gap that's been created here. The NASDAQ used to be a very fertile place for companies that were in the mid to large range. And, they were the innovators. They were the disruptors. And we feel like the NASDAQ 100 does very little of that right now. And we thought this was an interesting way to show that. And you can see the weight of just the top 10 stocks in the S&P 500 has gone from roughly 17% to 32%. So nearly doubling since, in the last 30 years. The big are getting bigger, no doubt about it. The FTC is on the march and really does not want this to happen. So there is talk about splitting up some of the larger names out there. We have no idea if that will happen. So far, they haven't done it in this administration. The EU has been more focused on forcing unbundling with Microsoft, for example. But historically, and you can see from 2000 to 2015, the concentration diminished. So we go through waves in the market of increased concentration. And then when it turns the other direction, then the ilk of stocks in our strategies gets a nice tailwind. We don't know when that's going to happen, but I did want to finish on this chart. It's just pretty striking. So this is the market cap of, and credit to Goldman Sachs, market cap of the largest stock relative to the 75th percentile stock. So the bottom, quarter, it would be the top stock of the bottom quarter. What is that ratio? Well, it's out to a record high, and that's telling us something. You can see how this series reverts to the mean, and you can see when it has happened. And when I first looked at this chart, I thought, 2000, 1973, 32 sounds like depression. So I thought, oh my goodness. But then in doing a little bit more analysis, and we're going to do a much deeper dive as time goes on. If you look at, there are two other times besides the 2000 tech and telecom bust, the 73 recession. That was a very serious recession. You see 64 and then 32 and 39. And if you look at what happened there, 32, the peak was there was massive fear, 29 through 32, massive fear and a crowding into the same stocks just because they seemed so safe. They had the highest cash flows and so forth. But look what happened afterwards. What happened afterwards, it was from 39 to 46 effectively. The market went up 45%. Or 5% at an annual rate. And you can see that those largest cap stocks underperformed relative to the rest of the stocks in the index. If you zoom in at 32 to 35, what you see is you see a 62% increase in the market. There was a sort of a big dead cat bounce. And then I think we might have ended up back in the soup in 37. But from 32 to 35, a 62% increase in the market. So 13% at compound annual rate as the market broadened out into lower cap stocks. And even in 64, for 3 years, 64 to 67, the market went up 26%. So that was 6% at an annualized rate. Again, more diversification, broader based market. So I would expect, especially now that we're at an all-time high, and that just gives you a sense of two things: how much indexation is driving this market and momentum to a few stocks. They're variously known as the FANGs at one time, or the Magnificent Seven, or now the Magnificent Six. But those sorts of moves end, and the markets broaden out in a healthy market. And what will cause that? If we're right, interest rates coming down will cause that. So we're certainly looking forward to that. Especially last year, the market did seem to start moving, to move in that direction. So that was the beginning, we think, of this move. But if we're right, this chart would suggest that the move has miles to go. And so we certainly are looking forward to that. And it'll be a very exciting time, because these 5 platforms, 14 different technologies, are going to transform the world, and they are going to make it a better place. So stay tuned. Thanks so much.